An investment that never falls is the riskiest investment. 1. Conceptual background. At first glance, an investment that never drops in value sounds ideal. But in finance, never falling can actually conceal hidden and extreme risk, because the price path doesn't show the actual risk profile of future outcomes. True risk is not about whether an asset moves up or down in the short term, but about the potential for significant future loss, incorrect assumptions, and structural vulnerabilities. The idea parallels the concept of a Tala distribution, where an investment typically shows small gains but hides a low-probability catastrophic loss, something that wouldn't be evident just by observing safe, upward-moving prices. 2. Why no drawdown can be dangerous. 2.1 Illusion of safety. If an asset's price never falls, investors may believe it's risk-free. But this can be the result of structural design, artificial support, or rare event masking. For example, some structured financial products can appear stable until a rare economic shock reveals a huge hidden loss. A history without drawdowns doesn't guarantee safety. It can mean the investment simply hasn't yet encountered extreme stress, or that risk is concentrated in tail events, rare, severe outcomes. 2.2 Hidden tail risk. Investments with little or no short-term downside might be subject to catastrophic loss in rare events. Model or assumption risk, if pricing formulas assume something that fails in crisis. Liquidity risk, cannot sell when needed without big losses. These hidden risks make a never down investment potentially more dangerous than a normal volatile asset, precisely because the investor underestimates the actual likelihood of severe loss. 3. Risk versus volatility. It's critical to distinguish volatility, price fluctuation, from true risk, loss of capital, or goal failure. Traditional metrics, like standard deviation, do not fully capture downside risk. An investment may show no volatility historically, yet still face extreme downside if its underlying assumptions break or markets face stress. 4. Investors' misperceptions. Many investors mistakenly equate stability with safety. They choose never down assets because they feel safe. However, such assets often offer lower expected returns, which increases long-term inflation and purchasing power risk, since not earning enough return can be just as harmful as losing value. Ignoring real risk in favor of perceived safety leads to misplaced capital allocation and can compound risk over time. 5. True risk is multidimensional. A robust investment risk framework includes probability of loss of principal, liquidity risk, inflation and opportunity cost risk, tail, rare event risk, structural or model risk. Just because an investment hasn't dropped historically doesn't mean these risks don't exist. It could mean that no extreme stress has yet occurred, or that the product's design masks risk until it's too late. 6. Conclusion. A financial asset never showing a decline is not evidence that it's safe. It can be the opposite. True risk lies in the potential for future loss, hidden vulnerabilities, and incorrect assumptions about stability. Passive stability may hide catastrophic tail risks. Lack of drawdown can encourage complacency. Real risk assessment requires looking beyond price history to underlying risk drivers, structural conditions, and extreme event exposure.